When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll be also talking about the markets, the rest of this year and 2 to 10 years to come. Also actions to consider in an IRA now that it is the month of August, listener questions, and then finally longevity and healthcare in retirement. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and Mesa. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic. Thank you. Always glad to be with you here in the radio and the fine people here of the greater Tucson area. Jeff, I talk to a lot of financial advisors, and I always seem to get differing opinions about a lot of things. Now, one of them I talked to recently talked about the next couple of months here of 2025 and 2 to 10 years into the future. He's really optimistic about this and really wants everybody to stay invested and thinks that AI is really going to be a big game changer and really is predicting the next 10 years to be sort of like that heyday times of the early 90s and late 80s. What's your opinion on that?
Well, cycles in the market repeat. We always have good times, and there's always a few bad times sprinkled in there. The 80s were a period of growth. We had a lot of fiscal changes during the Reaganomics era. It actually worked. We have Trumponomics now, and it seems to be working. It's certainly not doing the damage everybody thinks it's going to do with the tariffs and other things. Inflation isn't going out of control like they said it would. Yeah, the jobs numbers, although they're still fake and still having to be revised, probably aren't as good as they say they are, but, gave the market a little bit of confidence a week or two ago. And then we've had some economic data that isn't looking so good. Some of the earnings aren't really as robust as just because they're beating expectations and they lowered expectations prior to this quarter coming out. Some companies are beating expectations, some companies aren't. It's really kind of been hit and miss. I think the market right now is being more driven by kind of the tourist investor, the looky-loo investor, the one that's just looking for a hot stock trying to gamble rather than fundamental investors. And I think, in times of good economic growth and we have something new going on, whether it's, the dot-coms that ended up in a bubble and blew up, we had just some good overall across-the-board economic growth. We had increasing, back in the 80s, we had increasing manufacturing and things like that actually was good here at home, but then shortly thereafter we started giving it up. I think after Clinton, opened up the free trade agreement with China, and we started shipping all of our manufacturing elsewhere and buying things elsewhere and, shutting our economy down. So we don't have quite the same economic strength as we did before. However, we do have, a lot of technology that's growing right now. Hopefully the Trump era will usher in a new age of growing manufacturing, and we'll actually have some infrastructure and things like that. We've had trillions of dollars pledged. We'll see if that all comes in. I think it's on its way. We've already seen the increases in tariff revenues and things like that. So I think there can be, a period of economic growth. The things that worries me that offsets is the economic growth that came during the 80s was at a time when the market was not at all-time highs. The market was actually struggling. Remember, in the early 80s, we had interest rates at 18%. Stock market was struggling. The housing market was struggling. Nobody could afford anything because nobody could buy anything because they couldn't, get the money. They couldn't borrow the money. We had just come off of this worst period of stagflation during the Carter eras, a decade of pretty much no growth. We had the gas shortages. We had just layoffs, a lot of hard times, compared to what we've seen in the last couple of decades. A recession nowadays doesn't seem to last very long or hurt very bad or, even hit very hard. So I think there are some differences between, now and the last times when the market was ready to roll. But again, if you're going to compare it to the 80s, I think we have to remember that the market started out on a low point and had nowhere to go but up when we started out in the 90s, the market started getting some things kind of in play. The dot-com started boosting, hopes, and the, speculators all went in on anything .com and, made the market go crazy, out of control, right? It just went berserk where anything with a .com had value, even though there was companies that weren't even making any money, driving any revenues, or doing anything that was really economically or fundamentally support a stock price. So the 90s, we had this great growth in the stock market. We had some growth basically on the stock market wealth. There was some, growth economically. I think housing was pretty good, if I remember right. Things started stabilizing pretty good, and there was all this hype for what was going on in, the dot-com era, that nothing was ever going to be the same again. This was different this time, and the market was always just going to go to the moon because the dot-com was going to make, the internet was going to make everything so accessible, and it has. It's done incredibly good for the economy, for the world, for communications, for the amount of work we can get done in a day where we couldn't before. We can do so many things, multitask. The computers do it for us. So we had that age that ushered in, this great robust economy that was really not so economically based. It was hype and hope based, and it was market based. Then, we went through the big crash, the dot-com bubble burst. We had, all this hype about Y2K and the computer's going to reset. So everybody had to upgrade their networks and their systems and all that stuff. So there was just all this spending in the last part of the 90s decade. And then 2000s hit, ushered in by a great recession. So after that, the strong tech companies that emerged were, the Metas, which was at the time Facebook and Google and Amazon and, Apple, Microsoft. Those big companies were able to weather the storm and got bigger, while companies like WorldCom and Global Crossing and some of these internet companies that were, the promise of the future went out of business and were no longer around. So the big got bigger. They kind of gobbled up, all the people that were kind of sort of playing the game but weren't really in the game with the stability to win. And so emerged some huge companies, which are still the mega companies, the mega cap companies that are still driving the market. The Magnificent Seven, for example, mostly emerged from that era. So then what do we have? We have, what can we do now? Technology's going good, internet's going good. Well, let's create some hype around, the market crashed again. So now in the early 2000s, we've got this new thing going on. Well, shoot, the market sucks. Let's go into real estate. And then the real estate market went crazy. And then they started passing laws where anybody could borrow money. So anybody could get a loan from the bank for any reason. All they had to do is say the house is going to be worth more than I'm going to build it. And I may or may not be able to pay my mortgage. Don't worry about it. Let's worry about it later. And then they would box up these mortgages and sell them all over the world, rate them A+ rated, even though people that were getting these mortgages did it with stated income, typically fake income, typically not qualified to buy anything, not qualified to pay it back anyway. And yet they were getting loans, and then we had this big housing crisis, which again reset things again at a lower spot. So it seems like, the robust economies, the economic growth start usually after recession, after we kind of regroup when the price of the stock market and a lot of things are low enough to where we can kind of refocus. And this recession is a reset period, which actually has proven to be a good time because it gives us a nice starting ground or a kind of a foundation or a footing to start on. Right now, we're on the top of a skyscraper holding on with one hand, and we're thinking, great, how much further can we grow? How much higher can we go? And, somehow the economy is supposed to catch up to us, and we're not grounded. We're not even close to the ground. We're flying high. And I think that's what's different about now, even though I would love to believe that the AI phase or the AI age is ready to be ushered in. I wish the AI phase was getting ushered in after we had some sort of a sensible economy where we were starting off on the ground floor rather than starting off, hanging out the penthouse window, the tallest building in town, or, whatever. It doesn't seem sustainable regardless of how great the economics are in the AI business or the AI world. We've got companies that trade at hundreds. I mean, we're talking multiple hundreds of price earnings ratios. Companies that have market caps of billions and billions and hundreds of billions of dollars that don't even do $1 billion in revenues, let alone profits. And they should be doing that in profits, not revenue. So it's really crazy that, that these companies can hold on to these valuations, but people are willing to spend that much money on stocks. They've abandoned fundamentals. They've abandoned what, traditionally has been the worth of a stock or the worth of an investment or the worth of what you'd be willing to trade $1 for as far as earnings from a company. And it's just based on the next hype stock. It's based on the next good tip by Kramer on TV or the next tip somebody says on the news or somebody says, oh, Nancy Pelosi bought this stock, we should jump in. And rightly so, we probably should. I think she beats every hedge fund manager on the planet. But that's a different story. It's all, insider backdoor information, and it's stuff that, really shouldn't be happening. So I think the biggest difference is not that, it's different this time, it's going to go to the moon and we're on good fundamentals and earnings are going to continue to grow and the stock market can stay overvalued forever. because history says it can't. History says it doesn't. The market always returns to an equilibrium point. It always has, and I believe that it always will. Now, how much longer can this rubber band be snapped? I don't know. The market will keep going up until it doesn't. Every crash started after all-time highs and multiple all-time highs. We're at multiple all-time highs again. Is it right before the next crash? I don't know. We could still have more all-time highs. We retreated pretty hard a couple of Fridays ago. And by Monday, man, we were just rolling almost all the way back again. And then I think it was this last Tuesday, they had, market started off, and follow through for Monday. And then people got worried that, maybe the economy isn't so good or the economic news really isn't that great. Maybe we're overhyped and we should sell. And then tourist investors, whoever just comes up like, well, gee, buy on the dip. And so they push the market up again. I mean, there's really no rhyme or reason for it. The market is definitely overvalued. By any standard you use, by anything historical, you look at smart people like Buffett. Buffett indicator says it's overvalued. The Shiller indicator says that we're going to have a flat decade over the next 10 years. We'll be lucky to make a profit, which means the market may go up, but it'll also go down probably as much as it goes up over the next decade. So if you're going to get into the market, the best way to do is be very picky about the stocks and the sectors that you buy. Be very nimble and ready to get out when it looks like stocks are rolling over and there's time to take profits. We've been very fortunate to be pretty good at that last couple of years in this market being as weird as it is. But when it's overvalued like this, I think it's more fortunate and luck than fundamentally based. And unfortunately, unless you're in it for the long haul or if you can be a gambler, let's ride the market. But if you need the money within the next decade, you'll probably be sad to see that you'll spend a lot of your profits down with the volatility that's probably going to come. So I don't think we're going to see the same growth, even though people are saying, oh, look at this, it's just like last time. No, it really isn't, because the last times the economy's built from a good foundation and had this robust economic growth period was when the market wasn't overvalued. When the market's overvalued is when we've gone into a recession afterwards. And the market's overvalued when there's all kinds of hype driving it, like the housing market's going to the moon. Doesn't matter what you pay for a house, it's going up. That was what happened during the 2000 to 2008 before the crash period of time. And then by 2010, every house in the market was being foreclosed, it seemed, especially all the upper end houses that nobody could afford because they never expected to pay a mortgage anyhow. They were either going to flip it or refinance it at zero interest or interest-only loans, or some of the tricks that everybody was playing to get people into the housing market that created a boom, but it also created a big bust. Some of the houses, in fact, I hate to say, but I was part of the losing class on that real estate market hype when I decided to start getting into and built a couple of big spec homes. I built my dream home and a couple of spec homes. And man, the market crashed hard. Some of those spec homes just barely over the last 2 years, barely got back to the prices that they were selling at or they were appraised at back when they were built between 2005 and 6. Then they crashed. So again, the market took a hit. It's now coming back. And people are saying, yeah, look at, the market's going back. Look at all this, increase in real estate value. Look at how much these houses are going up. Well, a lot of that housing recovery was after the market decline of 50% or so on housing back in the 2010 range. So again, yeah, we have good times and bad times, and over 30 years, maybe the housing market will grow by about a 4%, 4.5% average rate of return, but you could have a decade of down or a decade and a half of time that it takes to get the market back to normal. That's the same thing that happened in 2000 with the dot-com crash. That took 10 years for the market to basically get back to even until 2014 before the market actually got above where it was before and stayed above it for the last time. So I think we have to enter this era of hope and hype with some caution, because there is a lot of hype. There's a lot of cheerleading. I hope somehow all the Trumponomics that is happening can lift earnings and lift the economies of these companies, and with more infrastructure building. And, if we can get the right tools in place and the right economic fundamentals and underpinnings in place in time and create earnings to catch up with the prices, the outrageous prices of the stock, maybe we'll avert a severe recession. But there has to be some sort of a meeting in the middle, in my opinion. There's going to be some sell-offs. There's going to be a time when I think the market's just going to do what it has to do, and it has to come back to some sorts of level of sanity. And, that's why financial advisors who are watching this thing, hedge fund managers that, are dialed in, are probably a good person to have at your side if you're trying to navigate this market and you have to, preserve some of your assets, but you still want to take advantage of what looks like still, potential growth ahead. I mean, it's amazing. It's baffling to me how high this market can go. And it's ended badly the time, 3 times that I've experienced it, 3 good times. The 87 crash, that wasn't easy. That was in the 80s. That was at the end of that robust growth from the early 80s to the late 80s. And then we had the dot-com bubble, and we had the banking bubble. And we've had some COVID issues. We've had a couple of things just lately that have been a little bit shaky. and have started what I would have considered the next kind of recessionary period or reset period. But it's been interrupted by government stimulus, by a little bit of hype, by just new things that come along. And by the way, when you have a whole bunch of dumb money, and I say that respectfully of people that are not in Wall Street and don't have all the information that they should have before making an investment decision, they do it the best they can based on what they know and the research that they do, the research that's available. But there's a lot of liquidity, and because of the stimulus and because of this, just the economic times, people that are really uninformed can throw money at the market and prop it up. But I don't think that's going to happen forever. I think those days are still limited. And I've preached that. And again, I'm doing that from a word of caution, not a word of doom and gloom or, oh my gosh, you got to get out of the market and, be scared. I don't want you to be scared. I want you to be respectful of what the market can do and how devastating it can be if you're already retired or if you think you're going to retire and you need that money. I'd rather, somebody get mad at me because they only made a few % return than get mad at me because they lost half their money in retirement because the market corrected and they decided to hang in there, hold out, it'll come back, when we know that sometimes it takes a decade or so to come back and stay back. And if you have to spend money in the meantime, those are losses locked in. I don't want losses locked in. And that's why we diversify across the board with the money you can wait on in the growth markets and take advantage of it. Money that you can't afford to lose, you put in accounts that'll generate income and be principal protected. And basically make a plan that's right for you. I don't mean you should stay out of the market. Just don't go into a market all in just because it sounds good at any given time if you need to preserve capital. I think that's probably enough pontificating on that point. That was a short question, and that was my long answer.
Well, I think you're giving us a reality check here, Jeff, and I think that's very important in today's world where some people may have an ulterior motive to pump things up, but always glad to hear your opinion. Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management, of course, our program called Premier Retirement. If Jeff's comments resonate with you, you can give us a call here to make an appointment to sit down with Jeff at 520-780-9059 to have that casual conversation about the market today and into the future. Any questions that you have about retirement, Jeff can answer for you, or growing your wealth or investing. 520-780-9059. You can also find out more about us online at premret.com. It's premret.com. Jeff, I hear from a lot of people, they're questioning Jerome Powell and the interest rate drop. I know that we just had a meeting here July 30th, and for the fourth straight meeting, Jerome Powell says, no, it's not time to reduce interest rates. Trump responded by calling him, among other things, a numbskull and a major loser. So how should we look at this interest rate situation with Fed Chair Powell? Should we be having an interest rate drop already, and what can we expect here for the rest of the year and on into the coming year?
Yeah, I'm really mixed on this. I support Trump and his economic agenda. I think he's a good businessman. I think he's doing a lot of things right, and I appreciate that. I don't appreciate him using those strong words about people, human beings that deserve to be treated like human beings that are trying to do their best job. I don't particularly like Powell, honestly, but I wouldn't call him those names. I think he's a well-meaning dude that wants to keep the economics in check, and that's what he's supposed to do. Now, there is kind of a conflict of interest, I think, if you think about what the Fed really is. The Fed is not a government agency. The Fed is basically created by the Rothschilds and the Rockefellers and the Vanderbilts in order to basically rule the world and control all the banks. And it seems like every time a president like John F. Kennedy says, maybe we should get rid of the Fed, they die. So I think, we don't need to get rid of the Fed. And I think Trump says get rid of Powell is about as far as he'll go on that one. But Powell has a job to do, and it's kind of a catch-22 for him. He's got to mitigate inflation, and the only way to really stop inflation. But the thing is, the Fed's a little too late on the plan because they should have started raising interest rates from 0 to 1%. They should have kept them around maybe 2 or 3% 5-10 years ago instead of dropping them to 0 in order to create this crazy market environment. It padded the stock market. It helped the rich get richer. And who are the rich? Well, the rich are all the people that basically started the Fed and own the banks and rule the world. So, the Fed, lowering interest rates actually helped them because they were able to amass great wealth by buying things without having to borrow money. Well, now they have all this stuff. They've got all this money. They've created all this wealth. Now interest rates are up. Guess what? Now they get to make money on the money that they've created. And they don't really want it to go down. So I think the powers that be that run the Fed they don't mind interest rates being up. I think they'd also love to have the fact that the economic situation in America, the U.S., would probably crumble so that they could have a chance to swoop in and gobble up things on a fire sale again and have a big old recession. And I think, high interest rates may even, cause that in the long run, because people can't buy things. People are getting exposed, man. They can't do stuff. However, here's the other thing. If they keep interest rates up, they make more money on their money, and the government has to finance all this crazy debt that they've created in order to create that. In basically, the transfer of wealth has been really from the government to the majority of the wealthy people, rich people in general. The rich people, big companies, the cabal that runs the world, the people that are in charge of the Fed. I'm not saying it's like a conspiracy theorist. It's just there are powerful people that have been powerful for a long time, and they're kind of behind the scenes, and they finance everything. The Fed is their tool. Not so much it is our government's tool. Now, they try to maybe take a little bit of advice and prodding from who was ever in charge in politics if it coincides with their agenda. Trump wants to lower interest rates just in order for two reasons. One is to get people to be able to buy stuff, and he's not worried about inflation so much. However, inflation really isn't in check, and it did tick up a little bit in the last couple of months. So, I think Powell has a reason to, stand firm on not raising or not lowering interest rates yet from the standpoint of keeping inflation in check. It was out of control. It was almost 10%, a year or two ago under Biden. And, we've got about a 30% increase in prices since Biden took office. And now those prices are not going backwards. They're still creeping up at, close to 3%. And we want the inflation rate to be 2%. How do we do that? Well, rather than raise interest rates some more, maybe we just don't, drop them for now. Just kind of see how it plays out and see if things will just kind of settle in and drop back down to that 2% rate. But I think if you lower interest rates, you create this buying or feeding frenzy where people will start buying up things and create inflation again. The other thing that Trump wants to lower interest rates is to finance the national debt. We've got this huge mess that has to be financed. And if we have to reissue debt at 5%, 10-year bonds, 30-year bonds, and even, 2-year bonds at, 5%-ish rates, that's a lot higher than a 1 or a 2% refinance rate. And when you've got $7 or 8 or $10 trillion in debt that has to be refinanced in the next, I think it's $7 trillion or more this year. That's a huge punch in the face to taxpayers and to, our budget. So that's going to be tough. So, I know Trump wants to lower it. He wants to refinance that debt. He thinks that, his program isn't going to really create inflation. I think by and large, lowering interest rates do. And also, my other point is this, and I made it before, Powell only has the ability to lower the interest rates on short-term interest. He can basically lower the Fed funds rate, the overnight rate that banks loan money at to each other and, to the Fed and so forth. What we've seen in the last few several months, is the bond market is tanked. China and other countries that own a lot of our debt is dumping it and driving our prices. Look at the ticker TLT. It's a 20-year bond. And you look at that TLT, it's gone down probably 10 or 15%, since it started going back up again a couple of years ago. And it's probably down 25 or 30 since its peak just at the beginning of the 22 kind of recession that we started going into that we bailed out of. But when the market crashed in 22, the bond market started crashing too. Bonds are still down 25 or 30%, sometimes even more depending on the length of the bond. That market has been hammered and is still hammered. If bonds go down in price, interest rates go up because mortgages and everything that people loan you money base it on what they could get on a bond if they just park their money in a bond. If they can park their money in a bond and make 6%, why would they loan it to you for 4 or 5 to get a mortgage when the bank could just invest their own money in bonds and make more money and appease their shareholders more? So, there's that catch-22 that Powell really, unless he starts buying up, and there's not enough money in the Fed to just start buying up bonds to drive the price up so that we can get interest rates down. I just don't see how that would happen. There was a time when the Fed could do that, but I think those days are over the last year or two where, we've got a lot of bad debt that the Fed's let float with the banks that owe the Fed money, but they don't have to declare their bad debts because they still kind of hold on to the paper. There's a lot of rules that banks don't have to follow that make them look a little stronger than they are. But the Fed and the banks are basically one and the same, and they work together. And they're not in as good a shape as they could be, or should be, or have been. And if they were, I think Jerome Powell could do a better job at lowering rates, making Trump happy, getting mortgages down and things like that. But there's really only a few tools he has left in his bag. And one is just lowering short-term interest rates. That's inflationary, and it doesn't make mortgage rates go down. So I think he's, kind of between a rock and a hard place. He's getting Trump slapping him in the face, calling him names. And, I'm sure he doesn't feel very good about that. And I wouldn't either. But I think Powell's probably doing the best job he can given what he's got to work with. But again, he was part of the problem, and he did take all of his marching orders from Biden and people that were not good economists this, and maybe some of the people in the banking system, the elite families that run the Fed, they were giving him the order. So he's basically been their lapdog and done what they've said, and now we're in a predicament, and he really can't do a whole lot about it.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management. We've been talking about the market, the economy, Fed rate cuts. Again, if our conversation resonates with you, you like Jeff's comments, you want to sit down with Jeff on a one-on-one basis, casual conversation, and talk about your journey towards a confident retirement. Basically anything that you want to talk about, Jeff is happy to have a conversation with you if it applies to growing your wealth and retiring confidently. 520-780-9059 is our telephone number. 520-780-9059. Make that call right now if you want. Leave your name and number, and Shelley will call you back during the week and set up that appointment for you on your schedule. Again, it's a casual conversation, totally complimentary, no cost, no obligation. 520-780-9059. You could also find out more about us online at premret.com, PREMRET.com. Jeff, let's take a break. When we come back here on Premier Retirement, we'll answer listener questions, and then later on, longevity and healthcare in retirement, how to tackle that and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan here on 790 KNST, Tucson's most stimulating talk. We're on the air for you Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. That's 4 times a week. If you've missed us on the radio, remember we're also a podcast. Go to wherever you get your podcast and search for Premier Retirement. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. 520-780-9059 is our telephone number. Get in on the conversation right now. Schedule an appointment to talk with Jeff. Make that call right now. Shelley will call you back and set up that appointment for you. No cost, no obligation, no judgment, entirely complimentary. All right, Jeff, let's get to listener questions this week. Our first question this week, Jeff, comes from Ben listening in Tucson. Ben says, I'm late to saving for retirement at 52, but can now afford to invest about $2,000 a month for the next 13 years. I want to retire at 65. Right now, I'm single and will have an average Social Security payment if Social Security is still around for me. I'll have my home paid off by then. I've been hearing advice about putting money into a good growth mutual fund. That seems very simplistic to me. What do you think, and how would I go about finding such a fund?
Well, mutual funds, I don't like mutual funds, frankly. I mean, they're basically traded to make profit for the company. You'd be better off picking ETFs, exchange-traded funds that have very low fees, that are more sector-based, unless you're going to do the research or hire an advisor to do the research and actually trade and focus on, going in and out of sectors when they have momentum and things like that. I mean, that's what advisors do, like us. If you want to pay a fee and hire somebody that can probably have at least more experience than you at it, and probably, not always, but probably, beat your own do-it-yourself record, you might try that. Mutual funds are supposed to do that, but mutual funds are so big, they just keep buying and holding, and they kind of trade, they do a lot of turnover. 75 to 80% of mutual funds don't beat the market indexes. My opinion is, if you want a good growth fund, and by the way, I would only go into a growth fund if you're going to dollar cost average it into it. I wouldn't just plunk all your money in it and sit on it, because if you look at today's market valuations, I think the Shiller-Cape ratio, if you have never heard of that, look at it. It's a historical statistic, or actually it's a metric that allows us to kind of see how the market will react in the next 10 years based on where the market valuation is today. And it's uncannily accurate. Based on where the market's valued at right now, the next 10 years should average somewhere around 0 to even negative as far as an average rate of return annually. And again, this goes back 70 plus years. Every up and down in the market is factored into this trend that signals us when it's a good time to buy and sell in the market, or what we should expect the market returns to be. Now, if you're going to average into the market, you're going to be buying low and buying high, but you're going to average down, which means your actual buy price, your cost basis will be lower at the end of those 10 years generally than the market would be in the next 10 years. But again, if you put it in when it's high, you might wait 10 years just to, have a couple of little market corrections happen along the way and be back to even and say, gosh, I should have just done a CD, which, could be the case. Now, you're 52, but if you're going to do the 2,000 a month, like you say, that's the time that you should do it. However, the easiest way to do it at 52, just because you probably, are working, you don't have a lot of time to visit with advisors, you probably don't have a lot of time to do a lot of your own research and learn how to do it, is I would just get an index fund. You could do QQQs, which is basically NASDAQ index. You get SPY, which is S&P 500. You can buy those as ETFs and just put that $2,000 a month into it for the next 13 years. And I think that you'll probably be fairly surprised and happy, even if the market is flat, that you're going to have made money in that period of time. So, you're going to have an average Social Security payment. You're going to probably want some growth there. Now, here's what I would also suggest, and I don't know if you have any other cash. Is this the first time you've started saving? Do you have other funds in 401ks, et cetera, that you might want to do something with? If you have old 401ks that can be rolled to IRAs, something you might want to also consider is something, let's say you have $200,000 from other savings and retirement funds that you can move because you're no longer with the company. It's not tied up in a 401k that you can't touch till you're 59 and a half, for example. If you're 52 and you have IRA money or something set aside, you could take those risks off the table. Basically, take that lump sum off the table, put it in an account that would give you a big bonus right up front, because you're not going to touch it for 10 or 12 years, 13 years or so. Have it grow at a guaranteed rate of 9.5% towards an income account that you could take income like an annuity from. I don't think the market is going to probably beat that from a standpoint of actual growth. So if you grew the market with that same lump sum of money and rode the market up and down and sideways for the next 10 years or so, I don't think, that's my opinion, but I don't think it would beat something that's principal protected that grows every year and has a guaranteed value in 13 years for income. It's kind of like building your own pension. That $200,000, for example, in 13 years would be worth somewhere in the neighborhood of $500,000 for income and generate, somewhere in the neighborhood of probably $25,000 or $30,000 in retirement income. That's just on like a $200,000 investment right now. So consider something like that if you have chunks of money so that you can guarantee income that would especially be there if you are concerned about Social Security being there or not. And if you have an average Social Security payment, I don't know what you mean by average, but let's just say it's $2,000 or $3,000 a month, but you have another $2,000 or $3,000 coming from a guaranteed annuity. It doesn't really matter how good or bad these $2,000 a month injections into the market do if your house is paid off and everything's in good order and you live on $4,000 or $5,000, you're already good. This $2,000 a month for the next 13 years, in my opinion, should be worth somewhere between $250,000 and $500,000, probably conservatively, and generate, another $20,000 or $30,000 a year potentially. So that's kind of how I would see this plan shaping out. I would be careful, again, just throwing in lumps of money. If you haven't already been in the market and received the growth from the market up to this point, I wouldn't just start right now. It just seems a little bit scary to start when the market is historically so high. But again, if you're starting at $2,000 a month, your dollar cost averaging in, that's a perfect way to do it.
Ben, we appreciate you listening to us in Tucson. That's a great question. We'll send you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Richard in Rancho Vistoso, and Richard writes, we have $1.6 million in a 401k and $1.1 million in other investments. Now, when he says other investments, he doesn't say tax or tax-free. How do we structure our withdrawals so we don't touch the principal?
Well, if there's only one way you can do that without touching principal, and that is interest only. The only way you can do that is interest only, right? There's other strategies. Let's say you put half of the money in an annuity that gave you a payment of $100,000 a year for the rest of your life, and you spent that down to zero, but you never touched the other 1.1 million and it grew to 2 or 3 million, you'd be back there above where you started with. So there's different ways to skin that cat, in my opinion, and still take advantage of, some of these income plays that do in fact invade principal purposefully, because that's what they're there for. But if you just want to live on interest, get the best CD and the best bond, or buy an annuity. There's 10-year annuities that'll lock in an interest rate close to 6% right now. That's tax deferred till you need it. That would be great on those other investments, especially if you're still working. Here's the deal, though. If fixed interest starts going down, you've got a problem with, lower interest rates. You could, with $2.5 million roughly, you've got to pay some taxes on that $1.6 million. Are you looking at, not touching principal even from that? I assume you don't really, you realize that a third of that, probably of that $1.6 million, 600 of that's taxes, right? And if you take just interest off of that account, you're going to have to take some of the principal out just because the required minimum distributions are going to force you to do so eventually on that 401k. So, here's a couple of other things. And I don't think you should, I think you're really limiting yourself by saying, I don't want to touch principal. If you want to leave a $3 million estate to your heirs, there's ways to guarantee that and totally touch the principal on some of that, but guarantee you higher income than you could do if you're just living off of interest. Maybe let's just say a 6 or 8% payout, maybe more like $150,000 or so, and still be guaranteed to leave at least that $3 million. And by the way, not leave it taxable in a 401k, leave it tax-free. There's tax planning. So if you're creative and you're willing to step outside of your comfort zone and do what we do day in and day out, because it's super comfortable for us to save you tons of taxes and give your family more than you plan to and help you live on more income. So your question is very simplistic. It's one that, if you ask an advisor that and all he did was offer you a fixed interest plan, he's probably somebody who works for a bank and has never had training in this business, in my opinion. But there's so many tools out there to accomplish what I think you're really trying to accomplish, and that is you want a certain amount left to your heirs. Otherwise, you'd be happy spending every last dime and living pretty rich on that money. If you just want to live on the interest, consider yourself, $100,000 a year and be happy, and that's probably plenty plus Social Security for most people to, eke out a living in Arizona these days. So that's probably fine. But again, you could use probably a third of that IRA and create enough income. Well, not a third, maybe 2/3 of that IRA, a third of the total investment amount that you have here, and probably live on enough guaranteed income and leave your kids even more if you structured it properly. Just have to take a look and expand your horizons a bit. I'll bet you'd find some things that are very intriguing and a lot more exciting for you.
Richard, thanks for listening to us in Rancho Vistoso. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. And again, if you'd like to talk to Jeff, 520-780-9059 is our telephone number. You can make that call right now. Leave your name and number. Shelley will call you back during the week and set up that appointment for you. It's not going to cost you anything to talk to Jeff. Okay, Jeff, Howard's listening to us in Catalina Foothills, and Howard says, I'm retiring at the end of the year with about $600,000 in a 401k. I'm 66 now and married. This is the only retirement savings I have. I still have about $180,000 on my mortgage, which runs $1,800 a month, and around $40,000 on a car loan and other miscellaneous debts. Should I take the money needed to pay off the mortgage and the car and the debts and invest the rest for income, or invest all of it and keep paying the mortgage and the other debts? So if his mortgage is $1,800, let's say it's $500 on the car, that's $2,300 a month, but he'd need to pull $180,000 and $40,000 out of his 401k. He'd need $220,000 to pay off his debts. So should he pay off the debts, or should he invest this money?
No, because he'd have to pull $300,000 out of his 401k because $80,000 of it's going to be taxes. So it's really going to cost you $300,000 to pay off $220,000 worth of debt. There's no way, in my opinion, that you couldn't do a little bit better than that, because 25% in combined tax bracket is higher than any interest I'm sure you're paying on those debts. By the way, that $2,300 a month isn't going to go down to zero, because you're still going to have about $500 a month in property insurance and taxes on your house anyway, so that the mortgage is probably only going to save you about $1,300 a month. On $300,000, there's no way in my mind that we can't structure a situation where that other $300,000 over the next few years while you pay that money down isn't going to generate more than the $1,800 or so that you save between the house actual mortgage payment and the principal and interest payment plus the car loan. No way. Don't do it. I had a lady that had about $600,000 in a CD in an IRA, and ended up buying her kid a house for $500,000. Didn't realize that she was going to have to come up with another $150,000 in taxes and didn't even have it. Asked me after the fact, what should I do? Well, it's too late. You need to get your house back and put it back in your IRA. Can you do it within 60 days? Because that's a 60-day putback rule. And it was already 60 days past time. So, you yank that money out and you find out about your tax bill sometimes, too late. After next year, your accountant says, hey, what happened here? You need $80,000 more to pay your taxes on this thing. It doesn't reduce your cash flow burden enough, in my opinion. That $600,000, though, if that's your only savings, let's say you did put $500,000. Let's say you did that same half. Let's say you put that half in a $300,000 of that into an account that would generate $2,000 a month starting next year. That covers most of what you're trying to save, and it would only take that. By the way, once the car and everything's paid off, that $2,000 a month continues to come in until you die. And that's for you and your wife, assuming she's the same age. And I'm guessing on the numbers, but it's pretty much in that range. And you still have $300,000 that you can buffer all your other living expenses with. If you want to set it up for more guaranteed income, maybe get another $1,000 or so off of another chunk of that. Or if you want to put it in some growth funds and, try to swing for the fences, because now that you have the retirement income paying all those extra bills and meeting all your needs because Social Security and pensions and things like that you already have are covering it, then maybe you can, expose yourself to a little bit of market risk and market upside with the other $300,000 because you don't have to worry about your income and the fact that your mortgage and your car is getting paid no matter what every month. So again, different ways to skin that same cat, save yourself from having that big tax bill. If you do it right, you may even be in a 15 or a 12% tax bracket going forward if you take it out month after month rather than taking a huge lump sum and being forced into a 22 or a 24% bracket, plus your state taxes of somewhere between 2 and 5% or whatever. Mm-hmm. So no, the answer is don't take that big chunk out. You never know. You might even need that $300,000. Heaven forbid some big health crisis comes up that's not covered with, Medicare or some insurance, and you need to tap that money. Just because you don't have a mortgage payment and stuff doesn't bring that $300,000 back.
And Howard doesn't tell us what his interest rate is, 3%, 6.5%. That makes a difference. And, that is one of the big questions that we get here at Premier Retirement many times. I've got the money to pay off my house. Should I do that, or should I continue to pay the mortgage and invest the money?
In this particular case, if you don't mind me interrupting, I don't care if he has a 10% mortgage. It's cheaper to pay the mortgage than it is to pay 30% taxes.
Right, and I would agree
in
with
this
you.
Case.
Yeah, right.
But if it was non-IRA money, then you have to compare interest rates for sure.
Right, and I would agree with you completely. Thank you so much, Howard, for that question. We appreciate you listening to us in Catalina Foothills. We will send you out Jeff's book, Retirement: The Road Ahead. Now, if you have a question for us you'd like us to answer on the air, you can get it to us by calling it into Shelley, 520-780-9059. Quite simple to do that. Or you can go to our website, primret.com, and leave it there. Either way, if we use your question on the air, we'll send you out Jeff's book, Retirement: The Road Ahead. And if you'd like to come in and sit down and talk to Jeff in person, no cost, no obligation, 520-780-9059 is our number. You can make that call right now. Leave your name, number, and Shelley will call you back during the week. Okay, Jeff, let's get to our final segment here on Premier Retirement, and that's going to deal with longevity and health care in retirement. And Jeff, this is a topic I think that's critical for anyone thinking about retirement today is healthcare and long-term care. So how can people protect themselves financially from these long-term care costs? Because they are quite substantial these days.
Well, they are, and here's one thing I will tell you is I am not a believer in pay-as-you-go, use it or lose it long-term care insurance. I think most people can pay for their long-term care with the equity in their home, either through a reverse mortgage. Most people, by the time they need long-term care, most people that I know, at least most of our clients, have their house paid off or very close to paid off. There's a lot of equity, and that's your ace in the hole should you ever need it. The other thing that I think is important, and by the way, besides taxes, for our clients, taxes are by far the highest, the biggest expense you'll have in retirement. It's a quarter to a third of what you take out is probably going to end up in taxes. Let's say 20%. I don't suppose you'll spend 20% of your entire retirement savings or income on long-term care, but you will spend a chunk of money very quickly for a very short period of time during those last final years. And that is probably the second biggest expense during, in retirement. So it's nice to have a little nest egg for that. One of the things that we really like as far as generating tax-free income is the LIRP, Life Insurance Retirement Plan. Life insurance is what we call asset-based long-term care. Asset-based long-term care means you put your money in, kind of like this little tax-free bank account where you get money out. Actually, you don't even take the money out. You just borrow against your own account that's growing at a higher rate than you borrow it. It has a death benefit on it because it's life insurance based. And the death benefit can be used during your life. In other words, you don't have to die to collect it. You can actually borrow against that death benefit. And since the death benefit is tax-free, you also borrow tax-free. Whatever you've borrowed, let's say you put a few $100,000 in the account, but it buys $500,000 in death benefit. And let's say over the next 20 years, you spend $300,000 of it as a loan, and there's still $200,000 in death benefit left in there. That you don't have to die to collect that. If you go to a nursing home or need long-term care in your home or just even some custodial care or assisted living in some cases, depending on how chronically ill you are, what the situation is, or if you're terminally ill, you can actually tap the remainder of that death benefit for those costs. And if you don't end up staying 3 or 4 years, or the term for the insurance policy that you paid $5,000 a year for forever and ended up only staying in a nursing home for a month, and you don't get the balance of that money back. With the LIRP, the Life Insurance Retirement Plan, The part you spend is the part you spend, but the part you don't spend still comes back to your family, to your spouse, to your kids, or to your estate, to your trust, whatever. So it's asset-based, meaning, you've got that money set aside, you leverage it with a little bit of extra life insurance, which honestly, over the course of your retirement life, probably will cost you less than a mutual fund fee, less than, what our money management fees would be. And you still have access to that money for those things that you need. The other thing is you can always reverse mortgage the equity in your home, which I started talking about earlier. And I don't think that is a bad deal at all. If you have a $800,000 home and it's paid off, you're 85 years old. What if you borrow $200,000 against it as a reverse mortgage in order to pay for your long-term care? Guess what? You don't lose the house. The bank doesn't get the house. All they do is they get their $200,000 back when your kids sell the house for $800,000. Now, if there's some interest that accrued on top of that, okay, so they pay that off. But chances are the house appreciated during that period of time of a year or two while you needed that money to live on. So again, you have a bank. You have two ways to bank on yourself. One is tax-free bank through LERPs, and the other is your home equity, which is also tax-free. You know why? Because you've already paid it down. When you pass away, your kids or heirs will get a step up in basis on it. They won't have to pay taxes even on the growth. You can borrow against it. When you borrow, you don't pay tax. It's not income. So again, and then, and by the way, the payments that you pay to the nursing home or assisted living facility or for that final expense healthcare could be a deduction against your other taxable income. So you get kind of a double tax break by using those two methods for the long-term, the healthcare retirement, and without having to worry about outliving your money, outliving your savings, or blowing all through all your investments.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management. We're talking about paying for long-term care in retirement. We're also talking about paying for medical expenses in retirement. Jeff, a lot of people have Medicare. I know it doesn't cover everything. Is it a consideration for the things that Medicare does not cover in terms of planning for these expenses and using something like a health savings account?
Well, you can use a health savings account if you have it. My opinion is a LERP is a better health savings account because you get the money out tax-free no matter what. Health savings account, if you end up needing to tap it for something other than health care. By the way, the LERP, you can tackle it for anything, but a health savings account, you can only use it for health costs. And if you do take it out, it ends up working like an IRA and you do end up having to pay taxes on the proceeds. So I'm not against health savings accounts. I think if you have access to them at work, fund them. I like leaving those alone and just letting them grow to whatever huge amount so that you can take care of it in the final stages of your life if you need it. You can also use it to supplement those costs that Medicare may not pay, as you mentioned. But Medicare is the only thing they cover is just a few days of skilled nursing care, not custodial care, and that's only if you've been admitted to the hospital. So there's some really stringent rules to get Medicare to pay for anything related to long-term care. So you're pretty much on your own, and you pretty much need to incorporate that into your plan. That's why we call it one of those 5 main pillars of planning when we talk about the Premier Retirement Planning methodology and the process that we use is, you've got to have the right investments that create the right amount of income. We have to make sure that you save as much in taxes as you can, that you pay all your medical bills either with good insurance or with some sort of alternative plan to generate the cash you need for long-term care, et cetera, and then to pass it on to your heirs with the least amount of trouble, the least amount of taxes to them. And again, it's one of those 5 basic ones that you need to look at. And if you can make it fit and dovetail into all those 4 other pillars and make it a cohesive plan, the picture looks a lot better. And that's what we try to do. That's why we're comprehensive planners is, our goal is to make that whole plan work together so that each part fits together with the next part, and it's kind of seamless.
And I might point out as well, too, that Medicare covers, if you consider long-term care 100 days, it covers things that you'll get better from. It's more rehabilitative care, as I said, covers about 100 days, but it doesn't cover long-term care. So how to pay for long-term care, that is one of the things that most people have on their mind when they get close to retirement. How am I going to do that? But as you said, the LERP certainly can solve that problem for you. Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management. Of course, we're on the radio for you each and every week for your fiscal fitness, your financial education right here. If you would like to talk to Jeff about your journey towards a confident retirement, you've got questions about preserving your wealth, creating income streams that you can count on, maybe reducing taxes. We can talk about estate planning, any number of things here. Give us a call right now. 520-780-9059 is our telephone number. You can leave your name, telephone number. Shelley will call you back and set up an appointment for you to come in and sit down with Jeff right here in the office and talk about anything that you need answers to. No cost, no obligation, no judgment. We'll meet you where you are. Again, it's 520-780-9059. You can also find out more about us online at premret.com, premret.com. Well, Jeff, that just about does it for this week. I want to thank you for your time, but most importantly, I want to thank our fine listeners for joining us. So for Jeff Ogan, I'm Jeff Shade, inviting you to have a great weekend. And we invite you to join us again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.